In trading, every decision we make is filtered through a psychological lens. No matter how advanced the system, how optimized the entry points, or how sophisticated the indicators, emotion remains the silent variable that shapes every outcome. It's the difference between executing with clarity and collapsing under pressure. The market does not care about intelligence, education, or even experience. It rewards emotional control above all else. Discipline is the armor that protects the trader's strategy from being destroyed by emotion, because when emotion takes over, strategy becomes irrelevant. Every trader begins with a plan. They map out setups, define entry and exit rules, calculate position sizes, and backtest historical data. On paper, the logic is flawless. But when the market opens, and price starts moving against them, that logic begins to erode. The human mind was not built to handle uncertainty with grace. It was designed for survival, fight, flight, or freeze. When money is on the line, and every tick represents either gain or loss, the brain interprets it as threat or reward. Dopamine and cortisol flood the system, hijacking the decision-making process. The rational prefrontal cortex is silenced, replaced by instinct and panic. This is where discipline becomes the separating force between a professional and an emotional participant. Fear and greed are not abstract ideas, they are physiological responses. When fear dominates, the trader cuts winners too early, terrified that profit will evaporate. When greed takes over, they hold losers too long, convinced the market will reverse. These reactions have nothing to do with technical analysis or strategy. They are driven by the emotional chemistry of uncertainty. A disciplined trader doesn't eliminate emotion. They recognize it, acknowledge it, and act in alignment with their rules despite it. That is the core of trading psychology, the battle between instinct and intention. Consider how emotion distorts perception. When the market moves against a position, the trader's focus narrows. They stop seeing structure and start seeing threat. Confirmation bias kicks in. They search for any piece of information that justifies holding, even when their plan says exit. Discipline interrupts this pattern. It enforces detachment from outcome and recenters attention on process. Without that anchor, even a perfectly crafted strategy becomes a psychological trap. The trader stops following rules and starts following hope, and hope has no place in a probabilistic environment. Discipline is the emotional regulator of execution. It keeps the trader from making decisions based on how they feel and forces them to act based on what they see. This separation between feeling and fact is what defines consistency. The undisciplined mind reacts to every fluctuation as if it carries meaning. The disciplined mind treats each tick as noise within a larger pattern. Discipline transforms chaos into structure, emotion into observation, and uncertainty into opportunity. Many traders believe they need a better strategy, when what they truly need is stronger discipline. The truth is that most trading systems already have positive expectancy. The reason most traders fail is because they deviate from those systems at the worst possible moments. The system tells them to cut losses, but they hold. The system tells them to take profit, but they wait. The system tells them to stay out, but they chase. Each of these actions is emotional, not logical. The moment emotion takes over, the trader stops being the operator of the system and becomes the victim of their own impulses. The market amplifies human weakness. It mirrors back every fear, every doubt, every hidden insecurity. A trader who craves validation will overtrade to feel in control. One who fears loss will sabotage themselves the moment they see red. A disciplined trader understands that emotion cannot be eliminated, but it can be managed through structure, position sizing, risk limits, journaling, and predefined rules. These tools are not mechanical. They are psychological shields against emotional contagion. Think of a disciplined trader as a scientist. They approach every trade as an experiment. The goal is not to win, but to follow the process with precision. The result, profit or loss, is feedback, not validation. The emotional trader, on the other hand, treats every outcome as a personal reflection of worth. A loss feels like failure. A win feels like superiority. This emotional attachment breeds inconsistency. Over time, the disciplined trader's equity curve may look slow and steady, while the emotional trader's curve spikes and collapses repeatedly. The difference is not in intelligence or market knowledge, it's in emotional governance. When emotion governs execution, traders experience what psychologists call cognitive dissonance. They know what they should do, but can't bring themselves to do it. Their rational mind says exit, but their emotional mind says wait. The longer they wait, the stronger the internal tension becomes, until they finally act, usually at the worst possible time. This pattern repeats until the trader learns that discipline is not about control, it's about surrender. Surrendering to the plan, to the process, and to the acceptance that uncertainty is part of the game. The disciplined trader builds emotional distance from outcomes through repetition and awareness. They don't try to suppress emotion. They study it. They journal every impulsive urge, every moment of hesitation, every emotional reaction after a loss or a win. Over time, this awareness transforms emotional chaos into data. They begin to recognize patterns not in the market, but within themselves. And once self-awareness develops, discipline becomes less about effort and more about identity. It stops being something they do and becomes something they are. Without discipline, emotion becomes the silent killer of performance. The undisciplined trader confuses excitement for opportunity and hesitation for safety. They jump into trades that feel good and exit trades that feel bad, creating a cycle of inconsistency. Every emotional decision reinforces neural pathways that make the same mistake easier to repeat. The disciplined trader breaks this loop by building habits that override impulse. They execute not because they feel like it, but because their plan tells them to. Emotion also affects perception of time. When a trade moves in favor, minutes feel like seconds. When it moves against, seconds feel like hours. This distortion leads to premature exits or irrational holding. Discipline anchors the trader in objective time, the time frame of their system, not their feelings. A disciplined trader does not chase instant gratification. They wait for confirmation, follow structure, and act with intention. The psychological cost of emotional trading extends beyond losses. It drains mental energy, breeds self-doubt, and erodes confidence. After a few emotional mistakes, traders begin to distrust themselves. This lack of self-trust becomes another layer of resistance. They hesitate even when setups are valid. Discipline rebuilds that trust. Each rule followed, each stop respected, each plan executed with integrity reinforces the trader's internal alignment. Over time, that alignment becomes unshakable. In the end, emotion sabotages strategy by exploiting the human need for certainty. Traders crave control in an uncontrollable environment. The disciplined mind accepts uncertainty as the foundation of trading. It no longer fights the market, it adapts to it. While emotion demands prediction, discipline focuses on preparation. One reacts, the other responds. And that difference, repeated over thousands of trades, defines success or failure. Emotional sabotage is not just about fear and greed, it's about attachment. Attachment to being right, to making money, to proving something. Discipline severs that attachment. It shifts the trader's identity from predictor to executor. Instead of trying to control outcome, they control behavior. Instead of chasing profits, they manage probabilities. The emotional trader operates in the realm of hope. The disciplined trader operates in the realm of process. Every moment of hesitation, every impulse to deviate, every urge to double down is a test not of knowledge, but of character. The market exposes weakness, not because it is cruel, but because it is honest. Discipline is the trader's defense against this honesty. It allows them to operate within chaos without becoming chaotic themselves. It gives them the emotional clarity to see reality as it is, not as they wish it to be. When emotion leads, strategy follows blindly, but when discipline leads, strategy becomes powerful. The strategy itself is never the problem, it's the human executing it. The disciplined trader can take an average strategy and make it consistent. The emotional trader can take a brilliant system and destroy it within weeks. That is why emotion, left unchecked, will always sabotage strategy. Only discipline can silence that noise long enough for logic to do its work. In trading psychology, the battlefield is internal. Every tick tests patience, every drawdown tests belief, and every win tests humility. The emotional trader fights the market. The disciplined trader fights themselves. The former tries to conquer price action, the latter tries to conquer reaction. The deeper truth is that trading success is not a measure of strategy, it is a measure of how well one can regulate emotion under pressure. Discipline is not the absence of emotion, it is mastery over it. And in the realm of trading, mastery over emotion is mastery over outcome. In the world of trading, brilliance is overrated. The market doesn't reward flashes of genius or sporadic moments of inspiration. It rewards the trader who shows up every single day and executes their plan with unwavering consistency. Strategy might get you in the game, but consistency keeps you there. It's not about who can make the most money in one trade, it's about who can survive the longest. The truth is that markets punish impulsiveness and inconsistency, and they quietly reward discipline disguised as routine. The traders who master the art of consistency understand that repetition builds stability, and stability builds results. Most traders come into the market searching for brilliance. They chase perfect setups, exotic indicators, and revolutionary strategies. They want to outthink the market, to find that one secret formula that others have missed. But in that pursuit, they overlook the one thing that truly matters: the ability to do the right thing repeatedly, even when it feels uncomfortable. The consistent trader doesn't need to be the smartest person in the room, they need to be the most reliable. Trading success is not a single event, it's a collection of disciplined actions compounded over time. Consistency begins with behavior. The consistent trader wakes up at the same time, prepares in the same way, reviews the same metrics, and follows the same process. Their day is structured around habits, not emotions. They don't trade based on how they feel. They trade based on predefined conditions. That repetition creates psychological safety. It removes uncertainty from decision-making. The mind functions best in environments where it knows what to expect. The moment randomness enters the routine, emotion follows. Consistency eliminates that noise, replacing chaos with structure. Brilliance, on the other hand, is unstable. It might lead to big wins, but it also leads to emotional highs and lows. The brilliant trader can make a fortune one day and lose it the next, not because the market changed, but because their behavior did. The market exposes inconsistency by amplifying emotional patterns. When a trader gets lucky, they believe they're smarter than they are. When they take a loss, they believe the market is against them. Both reactions disrupt rhythm and make consistency impossible. True professionals understand that brilliance can win battles, but consistency wins wars. The consistent trader treats trading like a craft. Every action, whether analysis, entry, or exit, is deliberate. They are not chasing profits, they are perfecting execution. Each trade becomes a repetition of skill, a chance to refine precision. Over time, this repetition creates muscle memory. The body and mind begin to respond automatically to market conditions without panic or hesitation. That is when consistency transforms into mastery. The average trader is still guessing, while the consistent trader is executing almost unconsciously, grounded in process and experience. Consistency also requires emotional neutrality. The market is an emotional roller coaster, profit and loss, hope and fear, excitement and disappointment, all within minutes. The consistent trader doesn't react to these fluctuations. They understand that each trade is part of a larger series, and no single result defines the outcome. They think in probabilities, not certainties. Brilliance is reactive, consistency is methodical. The consistent trader does not overvalue wins or overdramatize losses. They focus on the next execution, the next repetition, the next chance to stay aligned with their system. The psychology of consistency goes deeper than habit, it's about identity. Consistent traders don't just act disciplined, they become disciplined. It becomes part of who they are. They no longer need motivation to follow rules because the rules define them. The difference between an inconsistent trader and a consistent one lies in internal dialogue. The inconsistent trader says, "I hope this works." The consistent trader says, "I know what I need to do." That certainty doesn't come from knowing the future, it comes from trusting their preparation. There's an illusion in trading that complexity equals superiority. Many believe that the more indicators, strategies, or data they use, the more control they have. But complexity often creates confusion. Simplicity, when executed consistently, outperforms complexity executed erratically. The consistent trader builds systems that are easy to follow and hard to break. They understand that clarity breeds confidence, and confidence sustains consistency. Every decision in their process has a purpose, and that purpose is repeated until it becomes second nature. Consistency also creates emotional balance through predictability. The human mind craves patterns, it finds comfort in routine. When a trader executes the same process repeatedly, their emotional responses become predictable too. There's less room for impulsive reactions because each situation has been rehearsed mentally or in real trades. Over time, the consistent trader's emotions flatten. Wins and losses carry less weight. This neutrality is not a lack of passion. It's emotional maturity, born from repetition. One of the most misunderstood truths in trading is that consistency is not about never making mistakes, it's about responding to mistakes in the same way every time. The consistent trader doesn't spiral after a loss. They review, record, and adjust. They know that deviation, not defeat, is the real danger. The undisciplined trader treats every loss as a crisis and every win as validation. That mindset creates volatility not in their account, but in their behavior. The consistent trader focuses not on being perfect, but on being stable. Consistency is also a time-based edge. The longer you can stay in the game, the greater your chances of success. Emotional traders burn out because inconsistency drains energy. They go through cycles of obsession and avoidance, trading intensely one week, then retreating the next. The consistent trader conserves energy by maintaining rhythm. They treat trading like a marathon, not a sprint. They pace themselves through the ups and downs, knowing that longevity compounds results. There's a deep psychological satisfaction that comes from consistency. It creates a sense of control in an uncontrollable environment. Every consistent action reinforces self-trust, and self-trust is the foundation of confidence. When a trader knows they will follow their plan no matter what, the fear of the market diminishes. They stop trying to predict and start focusing on execution. This shift from external control the market to internal control themselves is the defining moment in every trader's journey. Consistency also separates professionals from amateurs through data integrity. The consistent trader produces reliable data because they follow the same process every time. Their journal reflects patterns that can be analyzed and improved. The inconsistent trader's data is meaningless. It changes too often to reveal anything useful. Without consistency, feedback becomes noise. The disciplined trader understands that performance improvement is impossible without consistency in behavior. Every great trader eventually learns that small, consistent actions compound into large outcomes. The daily act of showing up, managing risk, and executing with discipline builds exponential growth. The market rewards those who can withstand boredom, the quiet, repetitive, unglamorous moments of trading. Brilliance seeks excitement, consistency seeks progress. The consistent trader finds satisfaction not in the thrill of winning, but in the peace of alignment. Consistency also destroys the illusion of control. The market cannot be controlled, but the trader's actions can. The consistent trader narrows their focus from the uncontrollable to the controllable. Entries, stops, size, and mindset. This shift reduces anxiety because it places responsibility within reach. Inconsistent traders, on the other hand, fixate on price movements and outcomes they cannot influence, which fuels frustration and impulsive behavior. The consistent trader focuses on execution, not prediction, and in doing so, achieves a form of freedom within structure. Brilliance fades when stress rises, but consistency endures. Under pressure, the mind defaults to its most practiced behaviors. If a trader's default is inconsistency, stress magnifies it. If their default is discipline, stress strengthens it. That's why the consistent trader appears calm during chaos. They are simply falling back on habits they've trained for. The undisciplined trader tries to improvise in real time, and improvisation under emotional duress leads to disaster. Consistency is the rehearsal that prepares the mind for uncertainty. The pursuit of consistency is also a battle against ego. The ego wants novelty, excitement, and validation. It thrives on highs and despises routine. The consistent trader silences ego through humility. They accept that trading is not about being right. It's about being repeatable. They embrace boredom because they know boredom means they're doing it correctly. Ego chases adrenaline. Discipline embraces structure. That quiet, repetitive grind that most people avoid is where true traders are forged. Consistency also builds credibility with oneself. Each time a trader follows their rules, they strengthen an internal contract of reliability. Over time, that contract becomes a shield against doubt. When inevitable losses occur, the consistent trader can say, "I followed my process." There is no emotional punishment, no self-blame, only reflection. The inconsistent trader, on the other hand, is haunted by uncertainty. They don't know whether their results came from skill or luck. That ambiguity breeds insecurity, and insecurity erodes confidence. The market doesn't demand perfection, it demands persistence. Consistency is persistence in structured form. It means doing the same small things correctly, thousands of times, regardless of mood or market condition. It's the trader's commitment to process over performance. Every consistent decision compounds into trust, stability, and predictability. The trader becomes a system unto themselves, a predictable operator in an unpredictable environment. While brilliance seeks to conquer the market through intellect, consistency conquers it through endurance. The consistent trader knows that longevity creates opportunity. Each day of survival is another day of probability. They understand that a single great idea means nothing if it cannot be executed consistently. Brilliance produces spikes of performance. Consistency produces a foundation of reliability, and in the long run, reliability outlasts everything else. In trading, strategy is the blueprint, but the market is a living organism. It breathes, evolves, mutates, and adapts. Every second, millions of participants, each with different motives, capital, and psychology, reshape its behavior. This dynamic nature of the market renders any static system vulnerable. A strategy that worked yesterday might fail today, not because it was flawed, but because the environment that once favored it no longer exists. Discipline becomes the bridge between the rigid plan and the fluid reality. Without discipline, traders cling to outdated strategies like lifeboats in a storm, refusing to accept that the water has already changed direction. The static nature of strategy lies in its design. It's a construct of logic, built from historical data, assumptions, and backtests. It defines entry points, exit rules, and risk parameters based on what was. But markets don't operate in the past, they exist in the present, influenced by evolving fundamentals, liquidity cycles, and the shifting psychology of participants. When traders treat strategy as something sacred and unchangeable, they fall into the trap of rigidity. They begin to worship the system, rather than the adaptability required to survive in an ever-changing environment. Discipline in this context is not blind obedience, it's dynamic alignment. A disciplined trader follows the rules when they make sense, but has the awareness to recognize when conditions have changed. The undisciplined trader confuses consistency with stubbornness. They believe sticking to a plan means refusing to adapt, even as losses mount. The disciplined trader understands that adaptability itself is part of the plan. They follow their rules, but they also observe, reflect, and recalibrate. This ability to evolve within structure is what separates a mechanical executor from a true professional. The market's nature is psychological before it is technical. Every chart is a mirror of human emotion, fear, greed, euphoria, and despair. These emotions repeat in cycles, but their expression changes with time. The strategies that once exploited certain inefficiencies eventually lose edge as participants learn, adapt, or exit the market. When a strategy becomes too popular, it becomes predictable, and predictability breeds inefficiency. The disciplined trader doesn't chase what worked, they observe what is working now. They evolve their methods not through emotion, but through observation and analysis. Many traders fall into the illusion that a perfect strategy exists, a fixed formula immune to change. They spend years searching for it, backtesting endlessly, optimizing endlessly, only to discover that the moment they deploy it live, the market shifts. This is not coincidence. It's the nature of adaptive systems. The market responds to collective behavior. When too many traders act on the same pattern, it ceases to be profitable. The disciplined trader accepts this truth with humility. They understand that the edge is temporary and that survival requires continuous learning. Strategy without discipline is fragile. It assumes a linear world, where inputs and outputs remain constant. But the market is nonlinear, driven by feedback loops that amplify uncertainty. A single news event, an algorithmic glitch, or a shift in liquidity can invalidate months of research in seconds. The disciplined trader anticipates this instability. They manage risk not just to protect capital, but to preserve adaptability. Their priority is not being right, it's staying flexible enough to keep participating. The undisciplined trader reacts emotionally to change, while the disciplined trader responds systematically. Discipline acts as the stabilizing force amid chaos. It allows a trader to adjust without overreacting. When volatility spikes, the emotional trader panics, abandoning structure in favor of impulse. The disciplined trader recalibrates position size, widens stops, or steps aside temporarily. This restraint preserves not just money but mental clarity. In a dynamic market, adaptability is not just about changing strategies, it's about knowing when not to act. The disciplined trader understands that sometimes the best move is observation, not execution. The static trader views the market through a fixed lens, they see only what they want to see. The disciplined trader views the market as feedback. Every trade, every fluctuation, every anomaly provides information. Instead of resisting change, they study it. This psychological flexibility creates resilience. They don't label the market as right or wrong, they accept it as neutral. Their job is not to control it but to align with it. This mindset shift transforms uncertainty from threat to opportunity. Strategy becomes dangerous when it gives the illusion of certainty. Traders begin to believe they've decoded the market. This overconfidence blinds them to early warning signs, changes in volume, volatility structure, or correlation breakdowns. By the time they notice, the damage is done. Discipline acts as an early warning system. It keeps the trader alert to deviations from expected behavior. When outcomes diverge from the plan, the disciplined trader doesn't force the trade. They investigate. They seek to understand whether the market changed or they did. The dynamic nature of markets also exposes the limits of mechanical systems. Algorithms and quantitative models can process vast amounts of data, but even they must be re-optimized. Behind every algorithm is a human assumption about how the market behaves. When those assumptions stop aligning with reality, even the most advanced code fails. The disciplined human trader recognizes this and stays mentally agile. They may use technology, but they never surrender awareness to it. The undisciplined trader, however, hides behind the system, blaming it for their lack of adaptability. There is a profound difference between a trader who adapts strategically and one who adapts emotionally. The emotionally adaptive trader changes their plan impulsively, switching timeframes, abandoning setups, chasing new instruments, driven by fear of missing out or the pain of loss. The disciplined trader adapts through structure. They observe patterns of failure, analyze recurring conditions, and make calculated adjustments. This process-driven adaptability ensures evolution without chaos. It's not about reacting to every wave. It's about aligning with the current while staying grounded to the shore. The static strategy fails because it assumes repetition without evolution. Markets are built on human psychology, and human psychology is cyclical but not identical. Fear will always exist, but its triggers change. Technology, monetary policy, global interconnection all alter how these emotions express themselves in price. The disciplined trader remains a student of behavior. They don't just study price action, they study the people behind it. They understand that the crowd's behavior is the pulse of the market, and that pulse shifts over time. Rigidity often stems from ego. Traders they believe they've figured it out. They attach their identity to their strategy, and when it stops working, they feel personally attacked. This attachment leads to denial. They double down, ignore evidence, and defend failure as bad luck. The disciplined trader separates identity from method. They know they are not their strategy, they are the operator of it. This detachment gives them freedom to evolve. They can discard what no longer works without emotional resistance because they value growth over being right. In an environment that constantly evolves, the ability to remain disciplined while adapting becomes the ultimate skill. Too much flexibility without structure leads to chaos. Too much structure without flexibility leads to stagnation. Discipline provides balance. It defines when to hold firm and when to shift. It acts as a compass, ensuring the trader's evolution remains purposeful, not reactionary. The disciplined trader walks the fine line between consistency and adaptability, guided not by prediction but by observation. Market evolution can be subtle. It doesn't always announce itself with massive volatility or dramatic trend changes. Sometimes it hides in the microstructure, slower reactions to news, shifts in correlation between assets, changes in volume during key sessions. The undisciplined trader overlooks these details because they're fixated on outcomes. The disciplined trader notices them because they're fixated on process. They understand that staying relevant means observing the unseen. Every small anomaly is a clue to emerging behavior. Discipline also guards against cognitive inertia, the tendency to stick with familiar patterns, even when evidence suggests change. Traders who fall prey to this bias continue using outdated methods because they're comfortable. They confuse comfort with control. The disciplined trader, by contrast, values discomfort. They see it as a signal for learning. When the market challenges their assumptions, they don't resist, they explore. This curiosity keeps them mentally flexible and emotionally resilient. Adaptability requires humility, and humility requires discipline. The disciplined trader admits they don't know everything. They respect uncertainty rather than trying to conquer it. This humility prevents the illusion of mastery, which is one of the most dangerous mindsets in trading. The static trader sees the market as something to dominate. The disciplined trader sees it as something to understand. This psychological difference is why one evolves while the other decays. Markets reflect the collective psychology of billions. They adapt faster than any individual can predict. What worked in a low volatility environment may collapse in a high volatility phase. What thrived in a trending market may fail in consolidation. The disciplined trader prepares for this by building flexibility into their process, using risk management to control exposure, setting review intervals to assess performance, and continuously testing assumptions. This is not improvisation, it's structured evolution. A static strategy is like a photograph, an image of what once was. The market, however, is a movie, constantly changing frame by frame. To operate effectively, the trader must think like a filmmaker, not a photographer capturing motion, not moments. The disciplined trader understands that every frame matters, and that their role is to interpret movement, not freeze it. They build systems that flow with the market rather than fight it. This alignment creates longevity. The irony is that discipline makes adaptation possible. Without discipline, change becomes panic. The undisciplined trader reacts impulsively to every shift, mistaking noise for transformation. Discipline filters that noise, distinguishing meaningful change from temporary distortion. It gives the trader the emotional steadiness to adapt logically instead of reactively. Through this lens, discipline and adaptability are not opposites, they are partners. One provides stability, the other provides survival. The market's nature ensures that no strategy remains permanent. Every edge decays, every pattern evolves, every certainty dissolves. The only constant is change itself. In this environment, discipline becomes the trader's foundation, the steady rhythm that allows for fluid motion. Without it, adaptation turns to chaos. With it, evolution becomes intentional. Strategy may be static, but the disciplined mind remains alive, aware, and ready for whatever the next movement demands. In trading, winning is not the hard part, keeping what you've won is. Many traders experience brief moments of success, periods where everything seems to click. The strategy aligns, the entries are sharp, the exits precise, and confidence soars. But for most, those moments are fleeting. What follows is a familiar pattern. Profits evaporate, emotional control collapses, and what once felt like mastery turns into confusion and regret. The cause is rarely the market and rarely the strategy. The real culprit is a lack of discipline. Without discipline, every win contains the seed of its own destruction. The same psychology that drives victory without control becomes the psychology that fuels self-sabotage. Discipline in trading is not about restriction, it's about preservation. It's the ability to maintain control when success tempts excess. After a win, the human mind becomes dangerously confident. The rush of dopamine from a profitable trade creates a chemical illusion of invincibility. The trader begins to believe that they have figured out the market, that their insight or intuition is somehow special. This illusion leads to overconfidence, over-leverage, and overexposure. What starts as momentum turns into recklessness. One impulsive trade becomes two, and before long, a streak of good decisions is undone by one undisciplined moment. The undisciplined trader mistakes luck for skill. They attribute success to personal ability rather than probability. When the market aligns with their plan, they take credit. When it doesn't, they blame the system, the volatility, or external events. This inconsistency in accountability reflects a lack of internal control. Discipline demands humility, the acknowledgement that wins are not proof of mastery but outcomes of probabilities that must be managed responsibly. The trader who lacks this humility turns each success into a psychological trap, one that blinds them to risk until it's too late. Every win affects the trader's psychology. Small wins feel validating, but consecutive wins change behavior. The mind starts seeking the same emotional high. This addiction to success leads to impulsive trading, entering positions that don't meet criteria simply to recreate the thrill of profit. The disciplined trader resists this temptation because they understand that not all opportunities are real. They see the market as a probability machine, not a slot machine. The undisciplined trader, however, becomes intoxicated by their own results. They expand position sizes, shorten decision-making time, and gradually deviate from their strategy. The irony is that the same system that produced their profits becomes irrelevant because they no longer follow it. Lack of discipline also distorts perception of risk. After a series of wins, traders often perceive the market as safer than it is. They increase size without recalculating risk metrics, believing they can handle bigger losses because of recent gains. But the market doesn't care about recent performance, it only responds to current behavior. One oversized loss can erase days, weeks, or even months of consistent progress. The disciplined trader guards against this illusion by maintaining fixed risk parameters regardless of performance. They understand that variance doesn't discriminate between confidence and caution. The undisciplined trader, on the other hand, becomes complacent, assuming that because the last few trades worked, the next few will too. This assumption leads to ruin. The cycle of self-sabotage often begins after success. A winning streak breeds euphoria, euphoria breeds risk-taking, and risk-taking breeds vulnerability. The emotional mind craves expansion, more trades, bigger positions, faster profits. The disciplined trader interrupts this cycle through structure. They follow cool-down routines after big wins, step back to review execution quality, and remind themselves that success doesn't grant immunity from failure. The undisciplined trader feeds the emotional momentum, entering the next trade too soon, driven by excitement rather than logic. When that trade fails, they respond not with analysis but with frustration, leading to revenge trading, the emotional attempt to reclaim what discipline would have protected. Revenge trading is one of the clearest symptoms of undisciplined success. It doesn't only follow losses, it often follows wins that were lost again due to greed. The trader who watches profits vanish after breaking rules doesn't simply lose money. They lose psychological equilibrium. They feel betrayed by themselves. This emotional dissonance, knowing what should have been done versus what was actually done, creates an inner conflict that fuels impulsive behavior. The mind seeks to restore balance through action, but because that action is emotional, it only amplifies damage. The disciplined trader avoids this spiral by accepting that the market is not something to avenge, it's something to understand. Lack of discipline turns wins into losses, not just financially, but psychologically. Every time a trader violates their rules and gets away with it, the mind learns the wrong lesson. That discipline is optional when things go well. This illusion of control is more dangerous than any losing streak. It reinforces inconsistency at the neural level. The brain begins to associate undisciplined behavior with reward. Eventually, this conditioning erodes the foundation of performance. The trader starts taking greater risks unconsciously, justifying decisions with stories instead of rules. The disciplined trader, however, knows that consistency in behavior is more important than consistency in outcome. They measure success by adherence to process, not profit. When discipline is missing, emotional volatility increases. Each trade becomes personal. Wins inflate the ego, losses crush it. This emotional oscillation leads to exhaustion and poor decision-making. Trading becomes less about execution and more about emotional regulation. The trader starts using the market as a tool to feel good rather than to perform well. This is the most dangerous shift of all, when trading stops being an analytical craft and becomes an emotional dependency. The disciplined trader prevents this transformation by maintaining distance between identity and performance. They are not their results, they are their behavior. Another form of undisciplined behavior manifests through inconsistent application of rules. The trader who sometimes follows their stop-loss and sometimes moves it, who sometimes takes profit and sometimes waits longer, creates statistical chaos. They cannot distinguish whether their strategy works or not, because their execution corrupts the data. A strategy's edge only exists through consistent implementation. Without discipline, the trader destroys their ability to measure or improve performance. What could have been a reliable system becomes a random sequence of emotionally driven decisions. The disciplined trader, even in loss, maintains clarity because their data reflects truth, not emotion. The lack of discipline also reveals itself in the inability to handle boredom. The markets spend most of their time in consolidation, where opportunity is limited. The disciplined trader waits, patient and observant, conserving energy for high-probability setups. The undisciplined trader cannot stand stillness. They need movement, stimulation, and validation. They take trades just to feel active, mistaking action for productivity. These low-quality trades often eat away at the profits from disciplined ones. Over time, the trader realizes that it wasn't the losing trades that destroyed them, it was the unnecessary ones. There's a deep psychological irony here. Winning should reinforce good behavior, but in undisciplined traders, it often reinforces bad habits. Each successful violation of a rule makes it harder to respect rules in the future. The mind begins to rationalize breaking structure as skill. This pattern is dangerous because it's self-reinforcing. When the inevitable loss comes, and it always does, the trader is unprepared emotionally. They cannot handle the setback because their confidence was built on illusion, not discipline. The disciplined trader, in contrast, experiences confidence as quiet stability, not emotional euphoria. Their wins don't inflate them because they already expected them as part of the process. Discipline is what converts volatility into opportunity, but without it, volatility becomes chaos. The market will always test the trader's control. Sudden price moves, unexpected reversals, or temporary drawdowns provoke emotional reactions. The undisciplined trader sees these moments as crises. The disciplined trader sees them as confirmation that risk management works. They don't panic because they've already accepted the possibility of loss before the trade was placed. The undisciplined trader, by contrast, treats loss as betrayal and tries to fix it emotionally rather than structurally. This reaction transforms small, manageable losses into large, catastrophic ones. Lack of discipline also distorts time perception. The undisciplined trader becomes impatient, unable to wait for setups or let trades develop. They exit too early, or too late, constantly chasing a feeling rather than following a plan. This impatience destroys risk-reward ratios and erodes expectancy. The disciplined trader, however, aligns their pace with the market. They don't demand immediate gratification because they understand that trading success is not about frequency but about quality. Patience, which is a byproduct of discipline, becomes a psychological edge that emotion cannot replicate. Even when undisciplined traders make money, they often don't keep it. Their profits become emotional fuel for larger risks, which eventually backfire. This phenomenon, known as the trader's cycle, repeats endlessly. Success, overconfidence, overtrading, loss, frustration, reflection, temporary discipline, success again, and the loop continues. The disciplined trader breaks this cycle not by avoiding mistakes entirely but by learning from them consistently. They transform every emotional impulse into a data point for improvement. The lack of discipline also erodes the trader's relationship with themselves. Each time they violate their rules, they lose a bit of self-trust. Eventually, they stop believing their own promises. They say they'll cut losses, but they don't. They say they'll stop trading after a loss, but they continue. This internal betrayal corrodes confidence from the inside out. The disciplined trader builds the opposite pattern. Every rule followed strengthens integrity. This self-trust becomes the foundation for mental resilience. When the market becomes chaotic, the disciplined trader doesn't crumble. They rely on the internal stability they've built through consistency. In essence, discipline is what converts randomness into structure. Without it, success becomes unstable, and every win becomes a ticking time bomb waiting to explode into loss. The market constantly tempts traders to abandon control under the illusion of success. It whispers that the rules no longer apply, that they've evolved beyond restraint. The undisciplined trader listens. The disciplined trader hears the same whisper but smiles, knowing that temptation is just another test of control. In trading, the most dangerous enemy is not loss, it's compulsion. The urge to trade, to click, to act, to do something, even when logic says wait. This urge is born from the restless part of the human psyche that craves control in uncertain environments. Overtrading is not just a technical mistake, it's a psychological addiction disguised as productivity. The market provides infinite opportunity, and that infinity seduces the undisciplined mind. Every flicker of price feels like a chance missed, every quiet moment feels like a threat. The disciplined trader understands that the ability to not trade is a form of strength, not weakness. Discipline protects the mind from this destructive impulse. It filters noise, calms emotion, and teaches the trader that sometimes, the most powerful move is stillness. Overtrading is one of the clearest symptoms of emotional instability in trading. It comes from a deep psychological discomfort with uncertainty. The brain is wired to seek resolution, to end tension as quickly as possible. When a trader sees movement on the screen but doesn't participate, that tension builds. The longer they wait, the louder the internal voice becomes. You're missing it, you should have been in. Look, it's moving. The mind confuses patience with passivity, interpreting inaction as incompetence. Discipline rewires this reaction. It teaches the trader that inaction is not indecision, it's precision. Every moment of restraint reinforces mental strength, while every impulsive click weakens it. The irony of overtrading is that it feels like control but is actually loss of control. Each new position gives the illusion of participation, but in reality, it's a surrender to impulse. The undisciplined trader believes more trades equal more opportunity, yet, every additional trade dilutes focus, increases exposure, and amplifies stress. Overtrading transforms the trader's relationship with the market from strategic to emotional. The screen becomes a trigger, the trades become reactions, and the mind shifts from analysis to survival. Discipline disrupts this loop. It inserts structure where emotion wants freedom and boundaries where the ego wants expansion. At its core, overtrading is a failure of psychological regulation. It's not a sign of aggression or ambition, it's a symptom of anxiety. The anxious trader trades to relieve internal pressure, not to execute an edge. Each trade becomes a coping mechanism, a way to escape discomfort. But like any short-term relief, it compounds the problem. The more trades placed, the greater the chaos, and the greater the chaos, the more anxiety returns. Discipline, by contrast, is long-term regulation. It transforms the emotional need for control into a structured form of control-defined setups, specific risk limits, strict daily maximums. These rules act as anchors in a sea of emotional volatility. Discipline protects the mind from overtrading by enforcing clarity before action. The disciplined trader does not enter a trade unless conditions align with predefined criteria. They have a checklist, and if one condition is missing, they stand aside. This process-based approach trains the brain to value confirmation over impulse. Each time a trader waits for alignment rather than reacting to noise, they strengthen neural pathways associated with patience and decision quality. The undisciplined trader does the opposite. They reward impulse with action, teaching the brain that reaction equals relief. Over time, that pattern becomes automatic, and the market becomes a psychological trap. The psychological architecture of overtrading mirrors addiction. Each successful impulsive trade releases dopamine, reinforcing the behavior. The brain associates random rewards with excitement and begins chasing the next hit. This intermittent reinforcement is the same mechanism that drives gambling addiction. The trader starts trading not for profit but for stimulation. The disciplined trader breaks this cycle by creating predictability, consistent position sizing, consistent entry timing, and consistent evaluation. Predictability removes the emotional thrill that fuels compulsion. What remains is process structured, repeatable, and free from emotional highs. Another driver of overtrading is fear of missing out, or FOMO. This fear is not just emotional, it's rooted in identity. The trader feels incomplete when not involved, as if being on the sidelines means being left behind. The market's constant movement becomes a test of worth. The disciplined trader dismantles this illusion by separating self-worth from participation. They understand that opportunity in trading is infinite, but capital is finite. Missing one trade means nothing if the mind remains sharp for the next. The undisciplined trader, however, chases every flicker, desperate to prove they're not missing out, only to discover that missing out is less costly than overtrading ever will be. Overtrading is also the natural consequence of poor emotional recovery. After a loss, the undisciplined trader wants to make the pain disappear, so they re-enter quickly, trying to reclaim balance through action. This is revenge trading in disguise, and it almost always leads to deeper losses. Discipline prevents this by creating buffer zones, cool-down periods after losses, mandatory breaks, and structured review sessions. These pauses reset emotional equilibrium and prevent the spiral of reactive behavior. The disciplined trader understands that after emotional disturbance, the mind is least capable of making rational decisions. Waiting is not avoidance, it's recovery. One of the most overlooked aspects of overtrading is mental fatigue. Every decision in trading consumes cognitive energy. Each click, each analysis, each adjustment drains willpower. When discipline is absent, decision fatigue accumulates quickly, and the trader begins making emotional decisions disguised as logical ones. They start trading setups that aren't really there, lowering standards just to feel productive. The disciplined trader prevents this through structure, limiting the number of trades per day, scheduling rest intervals, and treating mental energy as a finite resource. By doing less, they achieve more because each action is deliberate, not reactive. The environment also plays a role in overtrading. Screens filled with flashing lights, real-time updates, and constant notifications stimulate the nervous system. For the undisciplined trader, this overstimulation becomes irresistible. Every tick feels like a call to action. The disciplined trader controls the environment as much as the behavior. They adjust charts to remove unnecessary indicators, silence alerts, and reduce sensory overload. They design their workspace to promote calm rather than urgency. In trading psychology, control of environment is control of mind. Overtrading is also tied to ego. The undisciplined trader believes they must always be right, always be active, always prove something to themselves or others. They equate action with competence. The disciplined trader's ego is quiet. They have nothing to prove because their confidence comes from process, not performance. They can sit for hours without placing a trade, unaffected by what others might think. This detachment from external validation is one of the deepest psychological strengths a trader can develop. It's the mark of maturity, a sign that the trader no longer seeks excitement but precision. Discipline also creates boundaries through metrics. The disciplined trader doesn't rely on feeling to decide when they've overtraded. They have data. They track the number of trades, win rate by session, emotional state per trade, and performance degradation over time. This data acts as a mirror. It exposes the moments where emotion replaced structure. The undisciplined trader, by contrast, avoids measurement because measurement forces accountability. They operate in emotional blur, convincing themselves that more trading equals more learning. But the market doesn't pay for activity, it pays for quality. Discipline transforms awareness into evidence, and evidence into control. Another subtle form of overtrading arises from inconsistency in timeframes. The undisciplined trader jumps from one timeframe to another, chasing action. They start on the daily chart, move to the 1 hour, then the 1 minute, until every flicker feels like an opportunity. This time compression destroys perspective. The disciplined trader remains anchored to their chosen time frame. They understand that clarity requires focus, and focus requires boundaries. Discipline prevents the temptation to dilute strategy through constant switching. It keeps the trader grounded in one rhythm instead of being pulled apart by many. The psychological toll of overtrading extends beyond performance, it affects identity. Every impulsive trade chips away at self-respect. The trader begins to feel out of control, ashamed, frustrated, and lost. This emotional erosion creates a feedback loop. The worse they feel, the more they trade, hoping to repair what only discipline can rebuild. The disciplined trader avoids this spiral by maintaining integrity. Every time they follow their rules, even when it means not trading, they reinforce self-trust. That self-trust becomes the foundation of long-term success because it allows the trader to operate from stability, not desperation. Discipline also protects against the illusion of progress that overtrading creates. The undisciplined trader believes that activity equals improvement. They tell themselves that every trade is experience, but repetition without reflection is not growth, it's reinforcement of error. The disciplined trader knows that one quality trade executed correctly teaches more than 10 impulsive ones. They spend more time reviewing than reacting, more time observing than participating. In trading, growth happens in silence, not in constant motion. Discipline makes that silence possible. Patience, as an extension of discipline, becomes the invisible armor against overtrading. It allows the trader to wait through dull markets, false signals, and emotional impulses. Patience is not passive, it's active control of desire. Every moment spent waiting for a valid setup is a victory over the urge to act without reason. The undisciplined trader feels time as an enemy. The disciplined trader sees it as an ally. Time filters randomness. It separates noise from signal, chaos from opportunity. The longer one can wait without breaking structure, the greater the advantage. Overtrading doesn't only destroy capital, it destroys clarity. When too many positions are open, attention fragments. The trader becomes reactive, unable to manage risk or follow structure. The mind loses sharpness under cognitive overload. The disciplined trader simplifies. They prefer fewer trades, fewer variables, fewer distractions. This simplicity creates mental bandwidth. When focus is undivided, precision increases, and with precision comes consistency. The undisciplined trader, however, thrives on chaos until chaos consumes them. There's also the illusion of making back time. After a period of inactivity or missed trades, the undisciplined trader feels pressure to compensate. They believe they must trade more to catch up, forgetting that the market has no memory. Discipline reminds them that each trade exists in isolation. The market owes nothing. Every attempt to make up for missed opportunities only increases risk. The disciplined trader moves from patience to action without emotional residue, approaching each trade as a fresh probability, not as redemption for the past. The core function of discipline in trading is emotional containment. It keeps the mind from expanding into excess. Without it, the trader's thoughts multiply like unfiltered signals. Every movement feels urgent, every possibility feels necessary. Discipline filters that noise into silence. It teaches selective engagement. Only act when your edge exists. Only risk when you have clarity. Only participate when the odds are measurable. This filtration is not about restriction but precision. The disciplined trader's energy is conserved for high-quality moments, while the undisciplined trader wastes theirs, chasing every flicker of price movement. In the end, overtrading is the absence of emotional discipline, masquerading as activity. It feels productive, but it's self-destructive. The market rewards patience, structure, and restraint, not aggression born from restlessness. Discipline is the shield that guards the trader's mind from the psychological seduction of constant participation. It creates space between thought and action, between emotion and execution, between impulse and intent. In that space, the mind becomes clear, and the trader finally learns that mastery in trading isn't about doing more, it's about mastering the urge to do too much. In trading, every participant is searching for an edge, a secret indicator, a new algorithm, a hidden pattern that will unlock consistent profitability. Yet, the greatest paradox of the market is that the real edge has never been hidden. It isn't found in charts, data, or systems. It lives within the trader. Discipline is the ultimate edge because it governs execution, shapes behavior, and stabilizes emotion. Every strategy, no matter how sophisticated, is powerless without the consistency of disciplined action behind it. The undisciplined trader will turn any edge into a liability, while the disciplined trader can transform even an average strategy into a powerful, compounding tool. In a marketplace defined by uncertainty, discipline is the one variable a trader can truly control, and that control becomes the foundation of every long-term advantage. The idea of an edge is seductive because it appeals to the intellect. Traders love to believe that knowledge or complexity guarantees success. They build intricate systems, experiment with indicators, or spend endless hours optimizing entries and exits. But edge isn't knowledge, it's application. The market doesn't pay for intelligence, it pays for execution. The gap between knowing and doing is where most traders fail. Discipline bridges that gap. It translates knowledge into consistent behavior under stress. Without discipline, information becomes noise, and strategies become empty formulas. The disciplined trader executes not because they know more, but because they can follow through when it matters most. What separates the professional from the amateur is not brilliance, it's behavioral reliability. The disciplined trader performs the same actions under pressure that they would in calm conditions. They can experience drawdowns, volatility, or missed trades without emotional collapse. This consistency of behavior is what gives them an edge over the majority, who crumble when markets deviate from expectation. In the short term, intelligence might produce impressive results, but over the long term, discipline determines survival. The market doesn't reward who's right once, it rewards who can stay in the game long enough for their edge to play out. Discipline is also the only edge that cannot be copied. Strategies can be replicated, code can be shared, and market structures can be studied, but discipline is internal. It's the trader's unique capacity for self-control. No one can imitate another's emotional framework or mental resilience. This individuality makes discipline the purest form of competitive advantage. It's the unseen quality that differentiates traders operating in the conditions with the same tools but producing drastically different outcomes. The undisciplined trader is a prisoner of emotion, reacting to price as if it dictates identity. The disciplined trader remains detached, responding instead of reacting, observing instead of chasing. That calm, patient consistency creates clarity in chaos, and clarity is the rarest edge of all. In an environment driven by probability, discipline transforms randomness into structure. Every trade carries uncertainty, but discipline gives it context. It defines how much to risk, when to enter, and when to exit. It turns potential chaos into a repeatable process. Without it, trading becomes gambling, and outcomes depend on luck. The disciplined trader doesn't eliminate uncertainty, they coexist with it. They build systems designed to survive randomness rather than escape it. This acceptance of uncertainty requires mental strength. The undisciplined trader wants control over outcomes. The disciplined trader seeks control over process. That difference in focus defines the boundary between consistency and chaos. The illusion of edge often arises from short-term success. A few profitable trades can convince a trader that they've discovered something special. But without discipline, success magnifies emotional instability. Confidence becomes overconfidence. Risk expands beyond control, and focus blurs into greed. Discipline is the only safeguard against this psychological expansion. It grounds the trader in humility. Each win is seen not as validation but as verification that discipline works. Each loss is not a failure but feedback for refinement. The disciplined trader's ego does not inflate or deflate with results, it remains steady, anchored by process. This emotional equilibrium is a deeper edge than any technical system can provide. Discipline also determines how a trader interacts with time. Most traders want instant gratification, they crave daily wins, fast results, and visible progress. But the market operates on its own schedule, not the trader's desires. Discipline allows a trader to synchronize with the market's rhythm rather than fight against it. It teaches patience, delayed gratification, and long-term perspective. The disciplined trader understands that consistency compounds. Each day of adherence builds momentum, while each emotional decision erases progress. Over time, this compounding effect of disciplined behavior creates exponential results not because the market changes, but because the trader does. The real edge of discipline lies in emotional regulation. Every market movement tests the trader's ability to remain balanced. When price surges, greed whispers to increase size. When price drops, fear screams to exit prematurely. Discipline silences both voices. It replaces emotional decision-making with structured response. The disciplined trader acts from clarity, not feeling. This psychological stability is invaluable because markets are designed to provoke emotion. They reward impulsiveness temporarily, then punish it permanently. The undisciplined trader rides these emotional waves until exhaustion, while the disciplined trader stands still, letting the storm pass. Discipline also safeguards the mind from the illusion of certainty. The market seduces traders into believing that with enough analysis, prediction is possible. But certainty in a probabilistic environment is a trap. It breeds rigidity, ego, and resistance to change. The disciplined trader embraces uncertainty as a constant. They prepare for multiple outcomes rather than fixating on one. Their confidence comes not from knowing what will happen but from knowing how they will respond when it does. This adaptability is another dimension of edge strategic flexibility born from psychological steadiness. In a broader sense, discipline is the architecture of risk management. Every trader speaks about risk, but few embody it. Risk management is not just a calculation of position size, it's an act of restraint. It's the decision to cut losses quickly, to walk away from setups that don't meet criteria, to protect capital at all costs. These actions are simple in theory but excruciating in practice. They require overriding the emotional desire to hold, hope, or double down. Only discipline can make this possible. It transforms risk management from a concept into behavior. And behavior, not theory, determines longevity. Another dimension of discipline as an edge lies in its relationship with boredom. Successful trading is monotonous. The setups repeat, the process repeats, and the routine rarely changes. The undisciplined mind craves excitement, it wants novelty, action, stimulation. But the market rewards repetition, not thrill. The disciplined trader embraces monotony because they understand that boredom is the environment where consistency is built. Each repetitive execution reinforces mastery, while each emotional deviation resets progress. What feels dull to the average trader feels powerful to the disciplined one because it represents control. Discipline also refines perception. The undisciplined trader sees opportunity everywhere. The disciplined trader sees it rarely. This selective perception is a hallmark of mastery. It filters noise and isolates signal. The disciplined trader waits for alignment across variables, price structure, momentum, volume, and sentiment before acting. This restraint may reduce frequency, but it amplifies quality. Over time, this focus produces not just better trades but deeper understanding. The disciplined trader's vision sharpens because it is not cluttered by chaos. Clarity itself becomes a form of edge, one that no indicator can replicate. In the realm of performance psychology, discipline represents self-regulation, the ability to maintain internal stability in external volatility. Every decision in trading triggers emotional feedback. Without discipline, that feedback controls behavior. After losses, traders become fearful. After wins, they become greedy. Discipline breaks this feedback loop. It creates emotional distance between outcome and identity. The disciplined trader evaluates each trade as an independent event, not a reflection of self-worth. This detachment preserves mental energy and protects confidence. The undisciplined trader, however, personalizes every result, riding emotional highs and lows that distort perception and destroy consistency. The real beauty of discipline as an edge is that it compounds invisibly. At first, its effects are subtle, slightly fewer mistakes, slightly more patience, slightly better entries. Over time, those small advantages multiply. Missed losses accumulate as saved capital becomes preserved confidence, and preserved confidence enables sharper execution. The compounding effect of discipline operates not in the account balance first, but in the mind. It gradually rewires thought patterns from impulsive to intentional. The trader stops chasing perfection and starts seeking precision. Each act of restraint becomes an investment in longevity. Discipline also creates resilience during drawdowns. Every trader experiences losing periods, but how they respond defines their career. The undisciplined trader collapses under emotional weight, questioning their strategy, abandoning process, or doubling down recklessly. The disciplined trader maintains structure. They reduce size, focus on execution quality, and review data objectively. Their identity remains intact because their confidence was never based on outcome, it was based on adherence. This resilience is a hidden edge that only emerges when markets become hostile. Anyone can perform when conditions are easy. Discipline reveals its power when they aren't. Another overlooked function of discipline is energy management. Trading demands intense focus, and without structure, the mind burns out quickly. The disciplined trader conserves cognitive energy by limiting decision-making to predefined conditions. They don't analyze endlessly or chase every opportunity. This conservation of mental resources allows them to stay sharp during key moments. The undisciplined trader, by contrast, wastes energy on constant overanalysis, emotional reaction, and second-guessing. By the time real opportunity appears, they're mentally exhausted. Discipline, therefore, isn't just control, it's efficiency. It directs focus to what matters and filters everything else out. The disciplined trader also treats failure differently. They don't see losses as personal attacks, but as data points in a long-term experiment. This scientific mindset prevents emotional interference and fosters continuous improvement. Discipline sustains curiosity without obsession. It allows the trader to remain analytical even after setbacks, turning pain into progress. The undisciplined trader, trapped in emotional cycles, cannot learn effectively because they resist feedback. Their ego interprets loss as threat, while the disciplined trader interprets it as instruction. Over time, this difference in attitude transforms both performance and psychology. In high-pressure environments, discipline becomes the stabilizer of decision speed. When volatility surges, emotions spike. The undisciplined trader reacts impulsively, driven by fear or greed. The disciplined trader operates from pre-planned responses. Their mind doesn't freeze because it doesn't need to invent a reaction, it simply executes what was prepared. This ability to remain composed in chaos is the most visible expression of discipline. It transforms the trader from a participant reacting to the market into an observer executing through it. Perhaps the most profound aspect of discipline as the real edge is its connection to self-awareness. True discipline begins with understanding one's own patterns when impatience strikes, when overconfidence appears, when fear of loss triggers hesitation. The disciplined trader studies themselves as deeply as they study the market. They journal thoughts, emotions, and reactions, recognizing that every external behavior originates from an internal state. Through this self-observation, discipline evolves from a set of external rules into an internal identity. The trader no longer has to force control. Control becomes natural. In a market where technology has leveled access and algorithms dominate execution, the human element remains the final differentiator. Two traders can use the same data, same setup, same system, yet achieve completely different results. The difference isn't in what they know, it's in how they behave. The market has always been and will always be a psychological game, disguised as a financial one. Discipline is the tool that allows the trader to play it with clarity, patience, and endurance. It is not glamorous, but it is absolute. Every great trader, past or present, has shared one common trait: not superior intelligence, not extraordinary foresight, but relentless discipline. Discipline is more than a trading principle, it is an internal transformation. It reshapes how a trader perceives risk, reward, failure, and success. It doesn't simply dictate how trades are executed, it changes the very fabric of the trader's thinking. To understand discipline is to understand oneself under pressure. The market is a mirror, and what it reflects is not strategy but psychology. The disciplined trader gradually realizes that trading is not a battle against price, it's a dialogue with self-control. Every chart, every position, every tick becomes a reflection of inner balance or imbalance. In the beginning, most traders chase strategy because it feels tangible. They believe that if they can just find the right pattern, the perfect algorithm, or the ultimate entry signal, they can eliminate uncertainty. But over time, they learn that uncertainty is not the problem, it is the only constant. What destroys performance is not the randomness of the market but the inconsistency of the mind. Strategy provides the structure. Discipline gives it life. Without discipline, every method becomes temporary. With discipline, even an imperfect system can become profitable through consistency and emotional restraint. Discipline begins as effort. It feels forced, deliberate, and uncomfortable. The trader must constantly remind themselves to follow rules, to wait, to respect risk limits, to detach from emotion. But with repetition, this effort transforms into habit. The act of following structure becomes natural. The trader no longer has to fight their impulses, they observe them without surrendering. This transition from forced control to embodied control is the moment when discipline becomes identity. The disciplined trader no longer has to remind themselves to stay disciplined, because discipline defines how they think, not just how they act. This transformation also changes the trader's relationship with time. The undisciplined trader views trading as a daily battle, a series of wins and losses that define their worth. The disciplined trader sees it as a journey of refinement. Each trade, whether profitable or not, contributes to a long-term evolution. Time becomes an ally, not an enemy. The emotional urgency that drives impulsive action fades away. The disciplined trader stops demanding immediate results because they understand that mastery is a cumulative process, built one consistent action at a time. Through discipline, the trader begins to detach from the illusion of control. The undisciplined mind craves certainty. It wants to predict the next candle, anticipate the next move, eliminate risk. But trading is a probabilistic game, not a predictive one. Discipline teaches the trader to control what can be controlled: risk, execution, behavior, and to release everything else. This surrender to the uncontrollable paradoxically creates peace. It replaces the chaos of reaction with the serenity of response. The disciplined trader doesn't fight the market, they flow with it. Over time, discipline shapes the emotional architecture of the mind. Fear becomes information rather than paralysis. Greed becomes energy rather than chaos. Regret transforms into reflection. Discipline creates emotional fluency, the ability to experience emotion without being consumed by it. The undisciplined trader swings violently between extremes: confidence during profits, despair during losses, euphoria during streaks, and panic during drawdowns. The disciplined trader experiences all these emotions but doesn't let them define behavior. This balance between feeling and function is what sustains performance across years, not days. Discipline also transforms perception of failure. Most traders enter the market fearing loss, as if it represents personal inadequacy. But the disciplined trader learns that failure is the tuition paid for skill. Each mistake, when examined without ego, becomes data for improvement. This shift in relationship to failure creates resilience. The undisciplined trader tries to avoid losses and ends up magnifying them. The disciplined trader accepts losses as part of the design, preserving both capital and confidence. Through this acceptance, they neutralize fear, which is the most corrosive force in trading psychology. As discipline deepens, the trader's internal dialogue evolves. The early-stage trader's thoughts are reactive: why did I miss that move? Why did I exit too early? What if I lose? These thoughts come from attachment to outcome. The disciplined trader's thoughts are procedural: did I follow my rule? Was the setup valid? Did I manage risk correctly? This shift from emotional reflection to process reflection changes everything. It replaces judgment with analysis, guilt with growth, and randomness with structure. The trader stops chasing perfection and starts pursuing precision. Discipline also extends beyond trading hours. The truly disciplined trader realizes that market behavior mirrors life behavior. Impulsivity in trading often reflects impulsivity in daily life. A lack of routine, poor sleep, or emotional instability outside the charts eventually seeps into trading performance. The disciplined trader therefore builds a lifestyle that supports psychological stability. Balanced routines, clear boundaries, deliberate reflection. Trading becomes not just a financial pursuit but a framework for personal mastery. The habits that create consistency in the market create consistency in the mind. The journey toward disciplined trading is often lonely because it requires self-honesty. It forces the trader to confront uncomfortable truths about their motivations, greed, fear, impatience, ego, validation. Most people don't fail in trading because they lack strategy. They fail because they cannot face themselves. Discipline demands radical self-awareness. It asks, what am I feeling? Why am I reacting this way? What am I trying to prove? The trader who answers honestly gains more insight than any market analysis could ever provide. Through this introspection, discipline becomes not just control over action but understanding of intention. With time, discipline redefines success. The undisciplined trader measures success in profit and loss, constantly fluctuating between elation and disappointment. The disciplined trader measures success by execution quality. They know that a well-executed losing trade is still a victory because it aligns with process. This redefinition removes emotional volatility from performance. The trader becomes stable because their self-worth is anchored not in outcome but in integrity of behavior. This internal stability is what creates longevity. It ensures that trading doesn't destroy the trader's mind, regardless of market condition. Discipline also acts as the invisible teacher of patience and humility. It teaches that no one controls the market, that certainty is an illusion, and that survival matters more than brilliance. Every trade becomes a lesson in acceptance. Acceptance of loss. Acceptance of imperfection. Acceptance of time. The trader learns that mastery is not domination but harmony. Harmony between logic and emotion. Between ambition and restraint. Between effort and surrender. Discipline is the force that balances these dualities. It is the mechanism through which the trader evolves from reactive participant to conscious observer. The greatest traders often speak less about technique and more about temperament. They understand that the charts are merely reflections of mass psychology, and their own mind is part of that collective rhythm. Discipline allows them to remain detached from the crowd. They don't chase consensus or follow noise. They act when their plan aligns and withdraw when it doesn't. This detachment doesn't make them cold, it makes them free. The disciplined trader is immune to the hysteria of others because they are governed by internal structure, not external chaos. As markets evolve, discipline remains the one constant skill that never loses value. Technology may automate strategies, algorithms may dominate volume, and patterns may change form, but human emotion remains eternal. Fear, greed, and impatience will always exist. Discipline is the antidote that transcends time and complexity. It ensures that the trader can adapt to any environment because their edge is not external, it's psychological. A disciplined trader is never obsolete because discipline itself evolves with awareness. In the deeper layers of trading psychology, discipline becomes a philosophy of living. It teaches self-control, awareness, patience, and balance, qualities that extend far beyond financial gain. The trader who masters discipline doesn't just improve performance, they improve as a person. They become less reactive in life, more intentional in decisions, more present in uncertainty. The lessons learned in front of the screen, restraint, focus, acceptance, echo through every other aspect of existence. The market, once seen as a battlefield, becomes a mirror reflecting human potential and limitation. When all the layers of strategy, analysis, and technology are stripped away, what remains is the trader, their habits, their emotions, their beliefs. Discipline is the thread that weaves all these together. It is the quiet force that turns randomness into rhythm, confusion into clarity, and potential into progress. Every tick of the market tests it, every loss sharpens it, every win tempts it. Discipline is not a skill learned once, it is a practice maintained daily, a dialogue between logic and emotion, order and chaos. The undisciplined trader seeks shortcuts, searching endlessly for the next system or signal that will guarantee success. But the disciplined trader knows there are no shortcuts, only refinement. They rise each day, not to conquer the market, but to master themselves. They understand that the market doesn't reward perfection, it rewards persistence, guided by control. Discipline becomes their compass, their filter, their defense, and their guide. It is the invisible architecture that sustains performance when emotion, volatility, and uncertainty threaten to destroy it. As time passes, discipline ceases to feel like effort and begins to feel like truth. It becomes the invisible rhythm of every decision, the foundation of calm amid chaos, the quiet confidence behind patience. It replaces the need to predict with the power to respond. It transforms trading from a game of chance into an art of alignment. And though many will keep searching for the hidden secret to trading success, the few who understand discipline will stop searching and start evolving, because they have already found what everyone else is chasing.